Hello, this is Gauri God, and today's topic of discussion is role of RBI in India. In this lecture, we are going to discuss functions of RBI, role of RBI, various instruments of RBI and current rates of different instrument of RBI. Let's begin with general introduction. Reserve Bank of India. The Reserve Bank of India was established on 1st April 1935 in accordance with the provision of the Reserve Bank of India Act 1934. Though originally owned privately, it was nationalized in 1949 and Reserve Bank is fully owned by the Government of India. On the recommendation of Hilton Young Commission, RBI was established. The central office of RBI was initially established in Calcutta, but in 1937 it was moved to Mumbai, where the governor presently sits and policies are formulated. RBI total capital of rupees 5 crores was divided in 5 lakhs share of rupees 100 each. Now let's discuss different functions of RBI. Functions of Reserve Bank may be classified into two parts: traditional functions and development functions. Traditional functions of the Reserve Bank may be classified as: first is central banking functions like note issuing, regulation credit, banks of banks, banker of the government, regulation of exchange. Other functions like clearinghouse functions, transfer of currency, publication of information, control over nationalized banks and other miscellaneous functions. Now let's discuss general banking functions. These are to accept deposits, to deal in bills, lending of money, to deal in foreign securities, to deal in costly metals, to deal with the banks of the other countries. Now let's discuss prohibitory functions. First is neither to participate in business nor to provide economic assistance. Next is neither to purchase, share nor to give loans against it. Another is neither to purchase immovable wealth nor to lend loan against it. Next is not to deal in time bill and not to give interest on private savings. Also not to advance loans without securities. Development functions of the Reserve Bank are: promotion of agriculture finance. Contribution of the Reserve Bank to the field of agricultural credit may be described as short-term agriculture credit, medium-term agriculture credit and purchase of share of the cooperative sugar mills. Second is promotion of industrial finance. Establishment of specialized institutions, national industrial credit, like that is long-term operations, funds, credit guarantee scheme for small scale industries, help to sick industrial units, export assistance, etc. Another is promotion of export finance. Several measures have been taken for export finance like special schemes, Export-Import Bank of India. Then promotion of banking. The Reserve Bank has undertaken several measures to promote the banking structure of the country. The main steps undertaken in this direction are: strengthening of banking structure, extension of banking facilities, extension of functional coverage, deposit insurance, development of bill market and training in banking. Role of RBI in India. The role of RBI is very vast in the Indian economy. It performs certain functions which are important to be done for the better economic conditions which other financial institutions are not allowed to perform in India. These are: it is the Central Bank of India. Next is RBI is the regulator in banking sector in India. It is regulator of money flow in India. RBI has the monopoly to issue note in India. It is the mentor who performs certain functions to regulate and boost up each and every sector in India. Another topic is monetary policy instrument. The policy is framed by RBI to regulate the flow of money in India. Monetary policy refers to the instrument under the control of central bank to regulate the availability, cost and use of money and credit. The primary objective of monetary policy should be domestic price stability. The stated objective of monetary policy in India is to promote sufficient credit for growth while ensuring that there is no emergence of inflationary pressures on this account. There are several instruments of monetary policy which is also known as weapon of RBI. These are, let's discuss one by one. First is CRR, that is cash reserve ratio. which means the share of net demand and time liabilities that banks must maintain as cash balance with the Reserve Bank. Another is SLR, which is the share of net demand and time liabilities that banks must maintain in safe and liquid assets such as government securities, cash and gold. Changes in SLR often influence the availability of resources in the banking system for lending to the private sector. Next is refinance facilities. Sector-specific refinance facilities aim at achieving sector-specific objectives through provision of liquidity at a cost linked to the policy repo rate. The Reserve Bank has, however, been progressively de-emphasizing sector-specific policies as they interfere with the transmission mechanism. Move on to the next topic, that is Liquidity Adjustment Facility, that is LAF. It consists of overnight and term repo or reserve repo auctions. Progressively, the Reserve Bank has increased the proportion of liquidity injected in the LAF through term repos. Now, let's discuss term repos. Since October 2013, the Reserve Bank has introduced term repos of different tenors such as 7, 14, 28 days to inject liquidity over a period that is longer than overnight. The aim of term repo is to help develop interbank money market, which in turn can set market-based benchmarks for pricing of loans and deposits, and through that improve transmission of monetary policy. Another is MSF, that is Marginal Standing Facility, a facility under which scheduled commercial banks can borrow additional amount of overnight money from Reserve Bank by dipping into their SLR portfolio up to a limit. Currently, 2% of their net demand and time liabilities deposits at a penal rate of interest. Currently, it is 100 basis points above the repo rate. This provides a safety valve against unanticipated liquidity shocks to the banking system. MSF rate and reserve repo rate determine the corridor for the daily movement in short-term money market interest rates. Moving further with open market operations, OMOs, these include both outright purchase or sale of government securities for injection and or absorption of liquidity. Next is bank rate. It is a rate at which the Reserve Bank is ready to buy or rediscount bills of exchange or other commercial papers. This rate has been aligned to the MSF rate and therefore changes automatically as and when the MSF rate changes alongside policy repo rate changes. Next topic is Market Stabilization Scheme, that is MSS. This instrument for monetary management was introduced in 2004. Surplus liquidity of a more enduring nature arising from large capital inflows is absorbed through sale of short-dated government securities and treasury bills. The mobilized cash is held in a separate government account with the Reserve Bank. The instrument thus has features of both SLR and CRR. Current rates are: policy repo rate is currently 7.25%, reserve repo rate is 6.25%, marginal standing facility rate is 8.25%, bank rate is 8.25%, reserve ratio CRR are 4% and SLR is 21.5%. Lending or deposit rate, base rate is 9.70% to 10%. Savings deposit rate is 4. Term deposit rate is for more than a year is 8 to 8.5%.
Let us summarize today's session in brief. Firstly, the Reserve Bank of India is established on 1st April 1935 in accordance with the provisions of Reserve Bank of India Act 1934. It was nationalized in 1949. The main function of RBI are to be the monetary authority, regulator and supervisor of the financial system. The role of RBI is very vast in India. It regulates the monetary cycle and regulates the Indian economy. Monetary policy refers to the instrument under control of central bank to regulate the availability, cost, use of money and credit. There are several weapons of monetary policy in India like CRR, SLR, LAF, MSF, OMOs and MSS. The current rate structures would be: policy repo rate is 7.25%, reverse repo rate is 6.25%. The marginal standing facility rate is 8.25%, bank rate is 8.25%. The reserve ratio, that is CRR, is 4%, SLR is 21.5%. The lending or deposit rates is 9.70%. The base rate is 10%, saving deposit rate is 4%. The term deposit rate more than 1 year is 8 to 8.5%. Thank you.